All right. Welcome to the first edition of Intelligent Investment Show Live, the very first endeavor of a live show featuring Matt Dahl and Garrett Lill from the Intelligent Investment Show. Really excited about this, Matt. Thank you for putting this together.
No, you're just great. This is definitely our first live time, our first live show. So everyone gets to see all the funky mistakes we make before you get to edit them out. We end up looking clever.
Absolutely. Well, for those of you who do not know me, which is probably everybody except Matt, my name is Garrett Lill. I'm a former advisor, and Matt and I host the Intelligent Investment Show podcast. It's available on Apple Podcasts, Spotify, Amazon Music, YouTube, wherever podcasts can be found. We're out there, and I host the my channel, the Wealth Partners YouTube channel and podcast network. So if you're here, this is all about Matt, but I'm going to steal just a little bit of self promotion time and say, hey, subscribe to the channel and check out more of our episodes on YouTube. And I've got other advisors around the country that we do a few podcasts with as well. So pretty cool stuff. And this is an exclusive event for ARPG clients. So after we're finished today, we'll release it to the public as a normal podcast episode. But you get the two unique benefits from being clients of ARPG. Number one, you get to see Matt before I get to the editing studio and clean up our mistakes. You get the raw version, and also we'll have an opportunity for you to post your questions and throughout the episode. So I can't promise we'll get to all of them, but please feel free to add your comments below, and I will keep an eye on those and try to give you a chance for Matt to answer these questions as we move along. So the purpose of this is to kind of bring the Intelligent Investment newsletter to life, is the way you worded it, Matt, and I love the way you said that. You do a great newsletter this quarter, fourth quarter 2024 / first quarter 2025 was the Phil Collins theme. I always enjoy the musical themes. So you started off with Land of Confusion and with the new president and the new administration, and let's face it, he's a bit of a volatile president. He brings a lot of uncertainty and what he's going to do next, kind of thing to the table. So you talked about how the market's kind of digesting the information and what to kind of expect moving forward in 2025.
Right, correct. So again, the purpose of these live webinars now exclusively for ARPG clients. They've been receiving this newsletter now for the better part of well over a decade, and we thought sometimes they get a bit complicated, and they can be nuanced and difficult maybe for people to kind of understand what I'm trying to say. We're going to try to bring these things to life and add a little bit more color to them, right? So, yeah, we started this. We finished last year, obviously, with a pretty busy quarter when we had the elections, and obviously we had the winner, and President Trump, and what's that going to entail for the markets? And the land of confusion comes. There's a lot of cross currents, right? There's a lot of cross currents. So there's some tailwinds, right? He's a very pro-business president. He's certainly not going to raise taxes. We think there's going to be less regulation, but there's going to be some headwinds, right? Obviously, the most popular one being tariffs, right? And what's that going to do? How is that going to affect the markets? How are that going to affect pricing and as far as the markets and actual products that people have every day? And so when we came into 2025, at the end of 2024, we had a pretty expanded multiple. Okay, so the market has done well. We've had 20 plus years in a row. We had just under 25% in 2023. Rebounding from basically a 19% loss in 2022. But then last year we had 23.31% expansion on the S&P 500. So we've had 20 plus years in a row. Now that's pretty rare. Okay. That happened in the late 90s, 95, 96, 97, 98, 99 were all over 20%, with the exception of 1999. It was up 19.53, right? But we can just fudge that, call that 20%. The last time that actually took place, although it came close in the 70s, 75 and 76, the last time that actually happened was 1954 and 1955. Okay, that was when it was, as we've let people know before, that's when it wasn't the S&P 500, it was the S&P 90, was only 90 positions on the S&P back then, and they didn't change the S&P 500 until 1957. So it's a pretty rare occurrence. So you sort of have this stock market almanac situation where, okay, we have interest rates that are elevated. We've had two 20 plus years in a row, 20 plus % years in a row, which is good. But we have a pro-business president, and we have strong earnings and good earnings guidance, and a really good economy, and a good labor market, and inflation cooling. So where does all that fit in, right? Where do we go from here? Because when there's a problem, it's like we talked about before, people are kind of hardwired to protect themselves, right? And we kind of know the action item to take. The action is, well, sell and go away, okay? Versus, okay, well, we've had a couple really great years, and do we think this year is also going to be good? Do we think this year is also going to be positive? If so, why? And how positive do we think we can get? Do we think it'll be based on the data that we have? So, and being that the data that we have is, frankly, coming from both sides, right? As far as, like, today is actually a good example, right? That we had the jobs number came in. Okay, jobs number came in 143,000 new jobs created in December. I'm sorry, in January. Consensus was 173,000. I was fully expecting yields to roll over further today. However, when I went into the bonds, I saw the 10-year jump basically 7 basis points, 6-7 basis points. What was going on? So then I went and I looked at the wage number. The wages increased 0.5% month over month. Yeah, 0.5% month over month. So that's why yields popped, and I think that's why the market's actually selling off today, is because of yields. Because we're kind of we've reached that inflection point of S&P earnings yield against 10-year Treasury yields, right? They're basically the same. So we have our good girlfriend, bad girlfriend scenario going, right? So that what we have now is we have an S&P at 22.23 times earnings, and we have a 10-year Treasury note with 22 times earnings. Yeah. So if that yield goes up any higher, it's really going to, I think it can really pull that multiple back, which would cause the price to really, really pull back. So being that we're at this stretch valuation, we have this elevated bond yield. Okay, the bonds are providing pretty decent competition now for the equity side. Okay, so, and we're not sitting at 15 times earnings, we're sitting at 22.25 times earnings. So there's just not a lot of room for error here, right? That's where we get into, kind of earnings are going to have to pull their weight. So, but I'll let you kind of go through.
Yeah, well, I mean, we've talked a lot about on the podcast, the last couple of episodes, about the banjo string tightening, right? And you don't necessarily know when it's going to break or if it's going to break. And I know that you're not trying to paint a dire picture for the market moving forward, because there's a lot of, when you say the word uncertain, I asked you this yesterday. If I say the word uncertainty or volatility, and we polled 100 investors, how many of those 100 investors do you think would connect or think of positive thoughts versus negative thoughts with that word volatility or uncertainty?
Right. 99% we think it's negative.
Right. And the others probably crazy. But reality is that there is something that I've heard referred to before as upside volatility, upside uncertainty. I may lose my job, but I also may win the lottery, right? Well, winning the lottery gives you a huge outlier on the upside, which increases standard deviation, volatility, and whatnot. And yeah, most of the time, volatility is connected to a lowering stock market. But you and I've talked before, in Trump's first term, and I don't know if you have numbers or in front of you on it, but it was a very volatile 4 years, but it had a positive overall impact. And a lot of times we think of higher volatility relating to lower returns, but if you have a negative 5% year, a negative 5% year, a negative 5% year, and then a positive 75% year, all of a sudden that increases quote unquote volatility, but that's good volatility, right? So there is a lot of uncertainty in the market right now, but it's not all necessarily bad.
No, in fact, that's a back to, I think, a couple episodes ago, we kind of discussed the beta coefficients, right? And how we look at, that's how we measure, that's a good way to measure volatility. It's basically an average of standard deviations over a period of time. Okay, that's what a beta coefficient is. So you look at the market, and we measured this a few weeks ago. Using the S&P 500 with the beta coefficient of 1, and its 5-year return of about, call it 75%. So NVIDIA is a great example of upside volatility. Okay, NVIDIA has a beta coefficient of 1.64, which means you took the volatility risk of about 135% rate of return over that period of time. Okay, but it returned 2,200%. So you had a lot of volatility. You had quite, 2/3 more volatility than you had in the market, but you got, basically a 20 times return on the money. Okay, now that is a specific, kind of unique, peculiar circumstance, but upside volatility, does have its merit, because as stocks really start to go parabolic and go up, they do have, what you get is you get the mechanical motion inside the stock market. People buy. Well, and like the short-term traders or whomever does it, then they want to sell off, take their profits, take their short-term profits, and you'll get those really sharp, nasty snapbacks, but then they're bought right back, right? And so you tend to see, volatile stocks don't necessarily, as a general rule, outperform, the market or other positions. But if the fundamentals are behind them, right, like NVIDIA for instance, NVIDIA is always a great example. They basically, posted anywhere between a 30 and 40% earnings growth over the last, couple of years, right? But their earnings growth are actually closer to 70%, right? And they have a $3 trillion market cap, and all of those other things behind them. There's a lot of tailwinds there. So we're seeing, okay, well, we've seen that stock move up, and we've noticed it has some nasty snapbacks, but we also can be pretty confident that, although it's trading at, 33 times earnings, it's probably still going to grow by, 50% next year. So, versus maybe more of a peculiar, penny stock or something like that, where you're just kind of buying it to buy it, hoping that somebody else buys it and you can sell it and sell it to somebody else. No, nothing like that. But it's more about, you can use that volatility, but it really helps if you have an understanding of the fundamentals behind it. And then you have to look at who you are, right? Are you a long-term investor like we are? We're long-term investors. We invest for the long term for our clients here, right? Or am I a day trader? Am I trying to buy it? I want to hit some hourly mark and then I'm going to sell it right off, right? So it just depends on what your objective is.
Yeah, and even at a very basic fundamental level, right? I mean, any stock, any market, any index, any marketable security, downside is capped at 100%. Upside can be higher than 100%, obviously, right? A stock that it's 100 can go to 1,000, but it can only go down to 0, right? So inherently, you've got this, the fancy term is asymmetric risk return profile, right? Where you can make more than you can lose. So that kind of ties back to that volatility a little bit, right? That there are positive things that can drive the market higher, and it has mathematically more capacity to go higher than it does lower just by the mechanics of the market. However, it's priced pretty high right now. I mean, it's priced for perfection is the way you've worded it before, and I think that's a pretty solid way of putting it. Yes, if the market, there are positive upsides that can drive it a little bit higher, but from the newsletter, you've mentioned earnings have to pull their weight. This is one of these times we need earnings to meet expectations and continue to grow into higher expectations. And I will say also, by the way, if you're just joining us, feel free, if you missed the intro, to post any comments or questions that you have that you'd like for Matt to try to address during the rest of the recording. Feel free to comment those, and we will try to get to those if we have time towards the end of the recording. But what are your thoughts on earnings heading into, we're kind of right in the middle of earnings season now, and as you commented in the newsletter, the need for them to pull their own weight and live up to expectations.
Right. So when we look at earnings and we look at S&P price, there's two sides to it, right? You have the earnings and you have the multiple. Okay. So if we look at earnings for 2025, we're expecting about $270 a share, $271 a share this year, right? That's about a 14.6% increase from last year. Okay. Last year we should be right about consensus right now is 200. 238.66. We are beating estimates right now by about 78% of companies. We have, I want to say about 60-ish% of the S&P has reported so far for the quarter, and this is the final quarter of 2024 reporting, and about 78% are beating by a median of about 6%. So I think the numbers would come in 240, 241, and we think we're going to be at 270, 272 for 2025. That's about a 14.5% increase over 2024. Now, that sounds great. And to the folks that are listening, they say, okay, so 14.6% or 14.5% this year. That was priced in last year. Okay, that's what the market does. So what we're looking at is 2026 earnings. 2026 earnings are looking to be about $305 to $315 a share. Right now, FactSet has it at $307.40 a share. We'll probably come in about the 310 range would be a pretty good estimate. But we're also, again, we're sitting at a 22.2 multiple. But we started this year at a 21.68 multiple. So I think there is room. I think there is a tiny bit of room, and I mean ever so tiny bit, maybe from the 21.6 times earnings we had to start this year to potentially 22.5 if things go well. Okay, so we might get a little bit of multiple expansion on top of a 13.5% earnings growth, and that could get us sort of to that 7,000 range on the SP. Get us that 19, 20, potentially where the market might finish in that 19 to 20% range. 3 20 plus years in a row, or 3 20% plus years in a row. That is certainly rare, but anything is possible. I mean, if you're looking at if we don't have any multiple expansion this year, and FactSet is exactly correct, and it's nothing but earnings growth this year, yeah, the market will grow by 13.5%. It'll put us about 6,600, right? 6,650, 6,675, right through there. But if we get a little bit higher than that, if we get a little bit 14.5, 15% earnings growth, and then we get not a full point of multiple expansion from 21.68, maybe 22.5, that's what would get us up into that higher bull case. Our bull case this year was kind of that. It's a kind of a wide delta, 6,800 to 7,200 on the S&P, more like 7,000 to 7,200 is the upper bull case, but that might be difficult to get to, being where multiples are, unless of course we get a real pullback in yields. Okay, and that pullback in yields can come from, I think we're going to see some pretty good CPI and PCE numbers coming out here pretty quick as we look into the core components of inflation, of CPI itself, right? There's been some real sticky problems that have been kind of keeping it elevated, right? And one of with auto insurance, shelter, and services, those have really started to roll over internally, and they have contributed to most of excess inflation these last few months, and that's what caused that hotter number in December. Okay, which is what caused yields to go from 4.17 at the beginning of December to 4.57 at the end of December, and per the newsletter, right? That's what killed the Christmas rally, right? Yeah. It was yields, right? And that yields were born out of 227,000 new jobs being created in November that were posted in December. And, obviously that CPI number that came in at 0.3 month over month, which is well above the Fed's target of 2% annually. So I think what we're going to see, some good CPI numbers, but the other thing I think we're going to see is, and this is specific if tariffs are actually implemented, okay? Because there's been a debate on, what are tariffs actually going to do? Are they going to raise prices? We don't actually believe that, okay? Tariffs are no more than a tax, okay? You've not increased demand on products. You have just made it cost more, okay? Mm-hmm. So does that necessarily mean it's inflation per se? No. Again, you've not increased demand, okay? So what then happens is you might have a price increase, which CPI might not be able to discern, okay? CPI might say there was a price increase on apparel, okay? And we attribute this 0.4% increase in prices in apparel month over month to tariffs. Okay. Now, when you go to the PCE number, which is the personal consumption expenditure number, and that is, again, that's the Fed's preferred measure of inflation, and here's why: because the Fed, that PCE measures how the money is spent on the apparel, right? So let's say apparel goes up 0.4% month over month, obviously about 5% annualized, which is way too high. Well, when the PCE number comes out, that apparel number might be normal, 0.2% month over month, because, okay, CPI can only measure the cost of the apparel, whereas PCE says, how do people spend money on the apparel? Well, maybe instead of going buying the Calvin Klein jeans, they stepped down and bought the Levi's, right? And that's where tariffs aren't going to have the impact on inflation that I think they will. And what it could do is it could cool things down to where it actually has the opposite effect and brings yields down. Okay, it actually brings yields down, and even cause some potential economic cooling to where the Fed might actually have to be even less restrictive, not necessarily becoming accommodative and cutting rates to accommodate the economy, but becoming less restrictive. So that could actually accelerate rate cuts, if that makes sense. I know that's kind of counterintuitive, but that's kind of how we're looking at it.
Gotcha. Another thing you commented on in your newsletter, and I'm going to kind of give you a 2-for-1 question here. You talked about in the newsletter the return of term premium, basically the yield curve reverting back to some sense of normal, where shorter term bonds are not going to yield as much as longer term bonds, getting a premium for purchasing longer term bonds as opposed to shorter term bonds. And you and I had also talked about on the last episode that there had been a slight shift in the correlation between the bond market and the stock market, and that yields had gone up and the market had gone up, and they had been kind of moving in a little bit of an opposite direction. Since that conversation, the market has just slightly drifted down. We're nothing very significantly, but yields have come down a little bit. Nothing extraordinary since we last talked, but they have cooled off a little bit. You and I have talked a lot about, and thanks for referencing that earlier, the good girlfriend, bad girlfriend, and that there is a limit to the tolerance the market has for higher yields, and you kind of feel like that is around 5%. And it's an interesting dynamic, and you kind of touched on it a minute ago, that at this moment, or we're right around it. I don't have the numbers in front of me. That's your job. But your price to earnings yield, if I buy the S&P 500, for every $100 I put into it, I earn, say, $4.50 back if you do the PE. If I invest in a treasury bond, maybe I get $4.60 for every $100 that I invest. So the yield from a 10-year treasury is higher than the S&P 500 earnings yield. So that sounds like we're getting more money to take less risk in the bond market, but to do that, you're sacrificing growth potential that you have in the stock market. So I'm kind of giving you, like I said, that 2-for-1. How do those two play together? The fact that we are pretty much at parity on the S&P earnings yield to the 10-year treasury yield, and how does that kind of play into also to the fact that you're seeing 20, 30-year bonds, you're expecting to see more of a term premium return there as opposed to the shorter end of the curve?
Well, I think we are going to see return to term premium this year, and it has to do with, I think the economy is in very good shape, and you get sort of that middle belly of the curve, that not actually toward the longer end of the curve, your 10 years and your 20s and your 30 years. That's more to your long-term economic growth, okay? And that's what that's attributable to. So I think we're going to see that end of the curve be relatively stable. It should come down a little bit, okay? We think, as a general rule, we believe interest rates are directionally lower this year. But you're really going to have to blow apart the yield curve to try to understand what components are going to move the most and why they're going to move, right? So again, back to the economy is really firing on all cylinders right now, okay? We have demographics, an absolute tailwind right now. The millennial population, okay, which is, I believe, you, the millennial population.
Unfortunately, yeah.
I know you're a closet Gen Xer like me, but
I'm a millennial by like 2 years or something like that.
Right.
So, and I hate being lumped into that, but yes, I am technically a millennial.
So we have a lot of demand built into our economy, pretty much through the year 2038. So there's a lot of that end of the curve that I think it's going to move around, but it's going to be relatively stable. But I do think it will come down a little bit. And as a general rule, from the beginning of the curve, from the shortest end of the curve, all the 1 month treasury bills, all the way to the 30 years, the whole thing will come down. It just won't be all in a straight line. When you get into sort of let's pick on the 2-year treasuries, right? Or the 2-year bills, 2-year notes. I'm sorry. I think those are gonna come down. The 3s and the 5s will really start to come down as inflation really cools, specifically in that PCE range. Okay, I think there's going to be a lot of business productivity happening. With business productivity, you have strong supply chains. With strong supply chains, you have lots of supply. With lots of supply, obviously, that's good for prices. And I think, along with the Fed being still restrictive. I mean, if you look at PCE at 2.7%, right now, we're at 4.5% on the upper bound of policy rate. We're still at 180 basis points of restriction. That's pretty restrictive. So we're going to see that short end of the curve, I really start to come down, and that in and of itself is term premium. So the idea of term premium, for those who are listening, is if you're going to buy a bond and you have a 30-year bond and it pays today 4.75%, you're going to hold that bond and you're going to receive 4.755% on your money every year for 30 years until it matures, and then you get your money back. Okay, so you're taking the risk of 30 years versus if you buy a 2-year bond and it pays 4.28% today. Okay, you buy that bond, you're only holding it for 2 years, and they're paying you 4.28% to hold it. Well, that seems like a pretty good deal. I'd rather just buy the one for 2 and forget about the 50 cents that I'm going to get every year, right? Because then I can change it in 2 years. I'm not stuck with this thing for the next 30, right? So what we had when we had high inflation for quite a while is where the shorter end of the curve is really sensitive to inflation numbers. Okay, so when inflation was high, you saw the 2-year really go through the 10-year, the 30-year, and everything. We had an inverted yield curve. Okay, we had an inverted yield curve. We have the shorter end of the curve higher than the longer end of the curve, which is not normal, nor is it healthy, because it's the shorter end of the curve, specifically the Fed policy rate. That's what banks buy their money for. Okay, Fed policy rate, what that is, that's the overnight rate that regional banks purchase the money from the Fed member banks at, which is currently, again, 4.5%. So if they're buying the money at 4.5% and so that you can go buy a house, okay, it's going to be a higher mortgage rate. Okay, so as that shorter end starts to come down because inflation is cooling and potentially the Fed starts to reduce rates, we're going to start to see that premium really start to expand to more historical norms, right? Where we get 150 basis points between the 2 and the 30, which is good. We get 165 basis points, 1.65 to 1.75% difference between the 10-year Treasury note and the 30-year fixed mortgage rates, which is very, very healthy. Right now, we're almost 3%. We're sitting at 7% on the 30-year fixed and about 4.5% on the 10-year. So 2.5%. We're 2.5% on that spread. So we're almost a full percent higher on that mortgage gap than it should be. And that's because that's that shorter end that the banks are buying the money for. Okay, they're having to lend it out and they have to make money on that. That's how they make their money, right? So that's what's causing the mortgage rates to be elevated is that shorter end of the curve. And I know people like to think that mortgage rates are correlated to the 10-year, which they are, but as far as the pricing is concerned, especially right now when we have a yield curve that's a little out of whack, it's more the shorter end that's going to affect the mortgage rates. And I do think we're going to see that shorter end come down. And I do think we're going to see a return to a normal relationship with mortgage rates in the 10-year, which would be good for real estate.
Yeah, I have a really hard time. And I mean, look, I was an advisor for 13 years. I'm a CFP. I've got my training, but I still cannot wrap my head around the concept of lending money longer term and getting a lower return on it than short term. That inverted yield curve to me sounds like backwards island or something that just makes no sense. So what we're seeing in this return to term premium that you're talking about is really normalization. This is not. This is just getting back to where the market is 95% of the time, or whatever the data says.
Correct. So and then back to sort of this correlation between the yields and the market, right? We obviously started the year at 21.68 times on the S&P 500, and we started the year at 4.57 on the 10-year. So we were about 22 times on the 10-year and about 21.5 times on the S&P. That was actually inverted. Okay, not a great thing. But what happened then is the market had kind of come down from an elevated position and brought that multiple in, and then it kind of back and filled again, kind of a mechanical thing because there was a lot of movement around Christmas and the inauguration and everything like that. And I think there was a lot of movement pricing up into the inauguration, honestly. So what we saw then is we saw the market, the 10-year go from 457 to 480 in that time frame. And that's when the market said, okay, I'm crying uncle, I'm done. This is too high. Okay. So, and now here we are, and the market is 22.23 times earnings today as we sit here. Okay. the 10-year Treasury note is 22.23 times earnings right now
Hey,
as we speak.
perfect.
So we have this really interesting inflection point as we sit here today. So what's going to move? Our yield's going to move down, and I think we're going to start getting that inverse correlation again between Treasuries and yields as Treasuries rally and yields come down. That should be good for equities. We really that's going to be specifically your Nasdaqs, which have a little bit higher multiple on them anyway, right? Or are we going to have a little bit of consternation on the fixed income side, and our yield's going to kind of fill back up into that 460, 465 range as we look through the 10-year, and that could cause kind of a bumpy road for equities in the short term. But I think all in all, if we're looking 2, 4, 6, 9 months down the road, we are directionally lower. Earnings are increasing, and I think we're absolutely going to, we're definitely sticking to our base case, bull case. Base case, call it 6,650. Bull case, call it 7,000 for this year on the S&P, and that's based on 2026 earnings and probably a 10-year that lives 25 basis points either side of 4. I think we have a kind of a lower bound on the 10-year of about 3.5%. Actually, it's 3.25 if you look at the charts. Okay, I can see the 10-year coming down to 3.25. To get it there, I think we would have to have a problem economically, right? Then the bad girlfriend might come back in, right? So now we like yields cooling, but now they've gone too far. Now you've gone too far, and we don't like this. So stop doing that. So, but it could get there, and that could be a pure momentum play, where treasuries are rallying and rallying and rallying, and they just momentum begets momentum begets momentum. So I could see it getting there, but that would be more of a function of momentum. And I think the area between 350 and 325 would be, again, back to the last show, that would be your 25 basis points of emotion, not 25 basis points of fundamental.
Yeah. Well, Matt, we made it 34 minutes live or 32 minutes live without, I don't think, making complete fools of ourselves. So that worked out okay, I think. For viewers who may have joined a little bit later, I really appreciate your being here. Feel free to subscribe to the YouTube channel here, the Wealth Partners YouTube channel, to see the Intelligent Investment Show podcast that is released we record it every other Friday. It's usually released around Monday, every other week, to see Matt and I with just sort of a candid market update. We have a good time with that. Also, on the channel, there's a few other podcasts that I do with other advisors. And if you are not on the live broadcast and you catch this, or the live stream, I guess I should say, welcome to 2025. If you're not on the live stream and you catch the replay of this, you may not be a client. So I should say that the Intelligent Investment Show and the Intelligent Investment Live webinar is for educational, entertainment, and general amusement purposes only. Neither Matt nor I we know nothing about your financial situation, so we don't know what to tell you what to do with your money. But if you would like to speak with a financial advisor and an investment professional, I know a fantastic one in Las Vegas. He has impeccable hair and is pretty well dressed when he puts a suit on. He can be reached at 702-655-8300 or go to intelligentinvestment.com to learn more about Matt and his team. Matt, I know you had to jump through a lot of compliance stuff to get this thing out there. Anything else you need to say before we go here to make sure we make all the attorneys happy?
No. First and foremost, I would like to thank all the clients who are listening now or will listen in the future. Thank you so much for your trust. Thank you so much for your trust in us and your confidence in us. We want it to be well placed. We try hard to earn it every day, and we will continue to earn it every day. If you're not a client, feel free to give us reach out to us anytime. We have a great team of advisors here that can help you.
I want to add one more unrehearsed plug here. I was an advisor for 13 years, and I was an investment geek. That was my thing. I loved the markets, and I loved just dissecting the markets and trying to figure out how to squeeze a little bit more money out of our returns for clients. And I mean, I have an ego, and I thought I was the best in the business at it. The numbers didn't support that thought at all, but I thought I was. But I have to say, I've really enjoyed the year, and we've been doing this for about 15, 16 months now. It's been over a year. And for the clients who are on the call, you have a very, very sharp gentleman in charge of your money. I've really enjoyed learning from him and hearing his comments on the show. And you're in good hands. And I would just give for what my humble endorsement is worth. Wanted to plug that because Matt, you're more humble about it than I would be if I was as smart as you.
Well, I don't know. I've not been very good at being humble in the past, and I don't want to start now.
All right, brother. Well, I enjoyed this. Hope clients and viewers enjoyed it as well. And I will see you very soon. And we'll do this again, I guess, in April. We'll do this again. So look forward to it. Hope you enjoy your weekend. Stay safe.
Yeah, looking forward to the next webinar for sure.
Absolutely. Well, have a good one. See you, man.
Thanks. Bye.